Right now, as I'm recording this in December 2025, something extraordinary is happening in the silver market, something that hasn't occurred in over 40 years. The silver futures curve has flipped into the deepest backwardation since the Hunt Brothers crisis of 1980. We're talking about a 2.88 gap where people are paying more to get silver today than to receive a promise of silver 6 months from now. Let me say that again. The market is screaming that physical silver is disappearing, while paper promises have become worthless. This isn't about silver going up. This is about a 150-year price manipulation scheme breaking down in real time. And when it breaks completely, physical silver won't just be expensive, it won't exist at any price. By the end of this video, you'll understand exactly how this manipulation has worked for over a century, who's been running it, why the Hunt brothers were destroyed for trying to expose it in 1980, and why what's happening right now in December 2024 is completely different and unstoppable. Let me start with what's happening right now, because these numbers are absolutely staggering. Between October 1st and November 15th, 2024, 37.6 million ounces of silver vanished from COMEX vaults. That's 47% of registered silver, gone in just 47 days. This is the largest vault drain since 1980. And you know what else happened in 1980? Silver hit $50 an ounce before the COMEX changed the rules mid-trade to stop the Hunt brothers, and the futures market nearly collapsed. But here's where it gets even more alarming. On November 17th alone, 6.3 million ounces were withdrawn in a single day. On November 21st, another 4.8 million ounces vanished. The vaults are being drained faster than they can be replenished. As of early December 2025, COMEX had only 43.2 million ounces of registered silver. That's silver actually available for delivery against futures contracts. Total COMEX vaults hold about 265 million ounces, but only that 43 million is marked as ready for delivery. Here's the problem. There are hundreds of millions of ounces in open futures contracts. If even 20% of contract holders demand delivery, COMEX literally doesn't have the metal. But it's not just COMEX. This is happening globally. On February 14th, 2025, yes, we're looking ahead just 2 months, 4 major South Korean banks stopped selling physical silver. Not reduced supply, not temporary suspension, stopped completely, indefinitely. These are Shinhan Bank, KB, Kookmin Bank, Hana Bank, and Wori Bank. Institutions with hundreds of billions in assets. China has blocked citizens from buying physical precious metals through banks. Russia was banned from London trading floors, but continues accumulating through other channels. And here's the ultimate signal that this is a genuine crisis. Silver is in backwardation. As of December 2024, spot silver is trading 2.88 higher than 6-month futures prices. This is the deepest backwardation in 44 years. In plain English, people are paying more to get silver today than to get a promise of silver in 6 months. That doesn't happen in functioning markets. That happens when physical supply is gone and paper promises are worthless. According to recent analysis from Improved Financial, this backwardation has persisted even as COMEX inventories reached record nominal highs of 531 million ounces total. But the registered category tells the real story, with lease rates spiking to 7.3%, the highest in over a decade. Before we go deeper into the manipulation, you need to understand why silver is fundamentally different from gold and why that difference matters. Gold is money, that's it. Gold sits in vaults, it backs currencies, theoretically. It's a store of value. But gold doesn't do anything productive. Silver is different. Silver is money. And the most critical industrial metal in modern technology. Your smartphone has silver. Solar panels require silver. Electric vehicle electronics use 3 times more silver than combustion engines. Medical equipment, antibacterial coatings, 5G infrastructure, missiles, semiconductors, every technology defining modern civilization depends on silver. And here's the critical difference. Unlike gold, silver gets consumed. When you use silver in electronics or solar panels, it's gone. You can't economically recover it. It disperses in landfills, electronic waste, and products that will never be recycled. Gold gets recycled. Almost every ounce of gold ever mined still exists. Silver disappears. We've been running a supply deficit for 4 consecutive years. In 2024 alone, we used 148.9 million more ounces than we mined. Where's that silver coming from? Existing stockpiles, vaults, government reserves built up over decades, and those stockpiles are running out. The solar panel industry alone could consume 85% to 98% of available silver reserves by 2050, according to University of New South Wales researchers. We're mining less silver every year while using more. The deficit is accelerating. So if silver is this critical, this scarce and this necessary, why isn't the price exploding? Because the price is manipulated, and it has been for over 150 years. The manipulation of silver didn't start in 1980 with the Hunt brothers. It didn't start in 1971 when Nixon closed the gold window. It started in 1873 with something called the Crime of 1873. In 1873, Congress passed the Coinage Act, which demonetized silver. Before 1873, the United States operated on a bimetallic standard. Both gold and silver were money. You could mint silver coins, exchange them for gold, and both were legal tender. The Coinage Act ended that. Silver was removed from the monetary system. Only gold remained as the backing for currency. Why? Because silver was abundant. Mines in Nevada were producing massive quantities. If silver remained money, the money supply would expand, prices would rise, and most importantly, debts would be easier to repay. Who benefits from deflation and tight money? Creditors, banks, the wealthy who lend money. They want money scarce and valuable, so debts are hard to repay and interest payments stay high. Who loses? Debtors, farmers, workers. The middle class, who borrow to buy land, equipment, businesses. They wanted silver monetized because it would expand the money supply and make debts easier to service. The crime of 1873 was a wealth transfer from debtors to creditors, disguised as technical monetary policy. And it worked. Deflation followed. Farm prices collapsed. Foreclosures exploded. Banks got richer. By 1900, William Jennings Bryan ran for president on a platform of remonetizing silver. His famous speech, "You shall not crucify mankind upon a cross of gold." He lost. Silver stayed demonetized. The gold standard remained, but silver didn't disappear from American life just yet. Silver stayed in U.S. coins. Dimes, quarters, half dollars, and dollars were 90% silver until 1964. In 1964, something critical happened. The market price of silver rose above the face value of coins. A silver quarter contained 18 cents worth of silver. When silver hit 129 per ounce, people started melting coins for profit. The government panicked. If silver coins were worth more as metal than as money, the entire coin system would collapse. So, in 1965, Congress passed the Coinage Act of 1965, removing silver from all circulating coins except half dollars, which were reduced to 40% silver. This should have been the signal. When the market values a commodity higher than the government does, the market is telling you the truth, and the government is lying. But instead of letting silver rise, the government sold silver from strategic stockpiles to suppress the price. From 1965 to 1970, the U.S. government dumped billions of ounces of silver onto the market to keep prices low. Why? Because rising silver prices would signal inflation. It would signal that the dollar was losing value. It would undermine confidence in fiat currency, just as the U.S. was printing dollars to fund the Vietnam War and Great Society programs. By 1971, when Nixon closed the gold window, silver was the warning signal everyone ignored. Gold and silver were both saying the same thing. The dollar is being debased. Fiat currency is failing. Hard assets are the only real money. And that's when the paper manipulation began in earnest. Once silver was completely demonetized and removed from coins, Wall Street created the paper market. Futures contracts on COMEX allowed traders to buy and sell silver without ever touching physical metal. Exchange-traded funds like SLV allowed investors to gain exposure to silver prices without taking delivery. Certificates, allocated accounts, unallocated accounts, derivatives, swaps, all paper claims on physical silver. Here's how the scam works. A bullion bank, let's say JP Morgan, holds 10 million ounces of physical silver in a vault. But JP Morgan doesn't just sell that silver once, they sell it 100 times through paper contracts. They issue futures contracts representing 1 billion ounces of silver. They sell ETF shares backed by the same 10 million ounces. They create derivatives and swaps with other banks using the same metal as collateral. For every physical ounce, there are 50 to 100 paper claims. As long as most people settle in cash instead of demanding delivery, the system works. The bullion bank collects fees, earns interest, and never has to deliver the metal. The price stays suppressed because the market looks like there's infinite supply. Every time silver starts rising, the banks dump massive paper contracts onto the futures market. Prices drop. Physical buyers get discouraged. The manipulation continues. But who's running this? Who benefits? The manipulation isn't random. It's coordinated by central banks, bullion banks, and exchanges. At the top, the Bank for International Settlements, BIS, the central bank for central banks. The BIS has a vested interest in suppressing gold and silver prices because rising precious metal prices signal that fiat currencies are failing. Below the BIS, the London Bullion Market Association, LBMA, where most of the world's gold and silver is traded opaquely, unregulated, dominated by a few major players like JP Morgan, HSBC, and Goldman Sachs. These banks hold massive short positions in silver. If silver rises, they lose billions. Then you have COMEX, owned by CME Group, a private corporation. COMEX sets the rules for trading, delivery, and margin requirements. And critically, COMEX can change those rules whenever they want, which is exactly what they did in 1980. In 1979, Nelson Bunker Hunt and William Herbert Hunt Texas oil billionaires started buying silver. Not for speculation, because they believed the dollar was collapsing. Inflation was 13%. Nixon had closed the gold window in 1971. The dollar was pure fiat currency, backed by nothing. The Hunt brothers believed that silver, real money for 5,000 years, would protect them from currency collapse. They were right, but they made a critical mistake. They used leverage. The Hunts accumulated 200 million ounces of silver, half physical, half futures contracts. They bought futures on margin, controlling massive quantities of silver with relatively little cash down. And they took delivery of the physical metal, draining COMEX vaults. In January 1979, silver was $6 per ounce. By September, $10. By December, $30. On January 17, 1980, silver hit $49.45 per ounce. The Hunt brothers were worth billions. They were the richest men in America. And Wall Street was in full panic. Why? Because if the Hunts kept taking delivery, COMEX would run out of silver. The exchange would default. Everyone would realize that futures contracts were backed by nothing. The entire paper market would collapse. COMEX did what exchanges always do when they're losing. They changed the rules. On January 7, 1980, COMEX implemented Silver Rule 7. No more long positions. Traders could sell, they could hold existing positions, but they could not buy. This wasn't a market decision. This was the exchange freezing out the Hunt brothers specifically. But silver kept climbing anyway, because the Hunts were holding, not selling. So COMEX raised margin requirements drastically. Overnight, the amount of cash required to hold futures positions increased by several 100%. The Hunts needed hundreds of millions in additional margin immediately. They scrambled to raise cash. They sold assets. They borrowed. But it wasn't enough. On March 27, 1980, Silver Thursday, silver collapsed from $21 to $10.80 in a single day. The Hunt brothers lost $1.7 billion. They declared bankruptcy. Brokerage houses teetered. The Federal Reserve had to intervene to prevent a systemic meltdown. The Hunt brothers were destroyed. Their mistake. They used leverage and played by the exchange's rules. And the exchange changed the rules mid-game. But here's what everyone forgets. The people who bought physical silver, not futures, not paper, but actual metal in their possession, they didn't lose anything. When the dust settled, silver was $10, $15. That's still 66% higher than where it started in January 1979. The lesson of 1980 is this. The system will change the rules to protect itself. Paper contracts are only as good as the exchange's willingness to honor them. But physical metal in your possession can't be confiscated, can't be margined out, and can't be ruled away. After the Hunt brothers were destroyed, the silver manipulation entered a new phase, institutional suppression. From 1980 to 2000, silver prices were range-bound between $4 and $8 per ounce, despite increasing industrial demand. How? Central banks and governments sold silver reserves, leased silver to bullion banks who sold it into the market, and allowed unlimited paper contracts to be created. The manipulation was so obvious that in 2004, a group of investors filed a class action lawsuit against JP Morgan and HSBC for manipulating silver prices. In 2020, JP Morgan paid $920 million to settle charges with the Department of Justice and the Commodity Futures Trading Commission for spoofing, placing fake orders to manipulate prices in precious metals markets. This wasn't a conspiracy theory. This was proven, prosecuted, and JP Morgan paid nearly $1 billion in fines. But did the manipulation stop? No, because the fine was less than 1 year of profits. JP Morgan paid the penalty and kept manipulating. Why? Because there's a deeper reason for the suppression. Silver and gold prices are the canary in the coal mine for fiat currency. When precious metals rise dramatically, it signals that people are losing confidence in paper money. Central banks need confidence in the dollar, the euro, the yen. They need people to hold bonds paying 4% instead of buying silver appreciating 20% annually. If silver and gold are soaring, it reveals that inflation is higher than official numbers, that currencies are being debased, and that the system is breaking. So suppressing silver and gold prices isn't just about profits for bullion banks, it's about maintaining confidence in the entire fiat currency system. But that suppression depends on one thing, physical supply, and physical supply is disappearing. In 1980, two men demanded delivery and nearly broke the exchange. The system changed the rules and crushed them. Now, in late 2024 and early 2025, it's not two men demanding delivery. It's sovereign nations, industrial users, and millions of investors worldwide. China has raised the risk classification on precious metals purchases. Chinese citizens literally cannot buy gold or silver through banks anymore because China is hoarding for the state. India's silver imports hit record highs in 2024-2025. Indians understand currency crisis. They know physical metals preserve wealth when paper fails. Russia was banned from the London bullion market in 2022, but continues buying through other channels. Russia's central bank has increased gold reserves every year since 2006. And now, the ultimate signal, backwardation. As of December 2025, silver backwardation has reached $2.88, the deepest since 1980. Recent data shows silver lease rates spiking to 7.3%, the highest in over a decade. This means large holders are unwilling to lend metal without significant compensation. People are paying premiums for immediate delivery because they don't trust that silver will be available in 6 months. The paper price is lying and physical is desperate. COMEX has 3 options. First, raise margin requirements to make holding futures prohibitively expensive. This forces speculators out but doesn't solve the physical shortage. Second, suspend delivery and force cash settlement. This means futures contracts get paid in dollars, not silver. Contract holders sue. The paper market loses all credibility. Third, let the market run and watch silver go parabolic. They'll try option 1 first. But that only works if demand is speculative. If industrial users need physical silver for manufacturing, they'll pay any margin. If sovereign nations are accumulating for monetary reserves, they'll take delivery regardless. When stage 4 hits, and it's coming, here's what it looks like. Trading halts become common. COMEX suspends silver trading for volatility or system issues. The real reason? They can't deliver. Delivery failures cascade, futures contracts default. Investors holding paper silver get cash settlement at prices far below physical market value. Premiums explode. Spot price says $60, physical dealers charge $90, $100, $120 just to get metal. Eventually, no price gets you silver. Dealers are sold out. Mints have year-long waiting lists. The paper market collapses. Futures trading suspended permanently. ETFs freeze redemptions, certificates become worthless, and physical silver, the actual metal in your possession, becomes the only silver that matters. This pattern has played out before, not just with silver, but with every commodity where paper claims exceeded physical supply. In 1971, when Nixon closed the gold window, foreign central banks demanded gold for dollars. The US didn't have enough. Nixon defaulted. Gold went from $35 to $850 over the next decade, a 2,400% increase. The pattern is always the same. Paper claims exceed physical supply, demand for physical accelerates. The system changes rules or defaults. Paper becomes worthless. Physical explodes. We're watching this pattern play out with silver right now. Global silver production, 830 million ounces annually. Industrial demand, 620 million ounces. Investment demand, 300 million ounces. That's 920 million ounces of demand against 830 million ounces of supply. The 90 million ounce shortfall comes from existing stockpiles. And those stockpiles are being drained as we speak. When the stockpiles run out, and they will, the only source of new supply is mining. But you can't increase mining overnight. It takes years to open new mines. Physics doesn't care about paper contracts. You cannot mine silver with monetary policy. You cannot print ounces into existence. The manipulation worked for 150 years because supply exceeded demand. That era is over. The window to act is closing. Not because I'm telling you to buy, but because the market itself is screaming that physical supply is gone. This is pattern recognition. And this time, the system can't stop it by changing rules on 2 men. They'd have to change rules on the entire world. If you found this valuable, hit that like button and subscribe. Share this with anyone who needs to understand what's really happening in the silver market. The truth can't stay buried forever, and December 2025 might be the month we look back on as when everything changed.